Hi, I'm Mr. Simons, and in this video we're going to look at liquidity ratios. And we're going to do this in the context of the Year 12 Business Studies HSC in New South Wales. If you're doing these kind of ratios elsewhere, it might still be relevant. I'll put a link to the syllabus in the show notes so you can check. So what we'll do is we'll go through a bit of the content, we'll look at the ratio itself, and then we'll do some practice questions. That if I'm thinking about liquid, that I am thinking about water. I am thinking about the asset that can move around the most easily. And cash, that's the asset that is most liquid. You don't have to sell something first. So if we look at this whole process of liquidity, what we are saying is liquidity is all about how easily assets can be made liquid. So what we're saying by that is not how easily can they be turned into water, but what we're saying is how easily can assets be sold and then turned into cash. And the reason why we care about this process is this. What we're looking at is how can a business turn its current assets, which are generally illiquid, so not very liquid, so something that is being held as an asset, how can we turn that into cash? And the reason why this is important, because what we're thinking about is how easy is it for a business to sell its current assets to cover its short-term obligations, its current liabilities. So if we are thinking about it in terms of big picture stuff, what we are saying is that we are looking at the fact that the business needs sufficient financial resources to pay its debts and cover unexpected expenses. So if we break this statement down a little bit further, what we are saying is that the business needs sufficient financial resources, and by that we mean the current assets, CA, and that what we're saying is that it needs these assets to repay its debts, things like accounts payable, interest, loans, and this here is the current liabilities. So while it all might sound a bit confusing, what we are saying is that does the business have sufficient assets to cover its liabilities? And that for these both being current, we are talking very much about the short term. So it's kind of like I've got debts, I've got things that I pay. What have I got to sell in order to be able to cover those debts? So let's look at that relationship. So if a business holds insufficient current assets, right, it may not be easily able to cover its current liabilities. So it may not be very financially stable. If a business holds too many current assets, well, you can't really use all those assets at the same time necessarily. So it could be wasted as we can't use them simultaneously to produce revenue. So in this second situation, what a business is saying is like, okay, so what we'll do is we'll accumulate a lot of assets so that when expenses come around, bang, we've got all these things that we can sell. But they're sort of sitting idle. They're not being used to produce anything, and they're just wasted. It's just money that's been spent on something that's not going to be used. But we definitely want to avoid this insufficient situation so that when expenses come along, we don't have enough to take care of them. That would be a very difficult situation. So if we finally look at the ratio itself, this is the liquidity ratio. It's called the current ratio. It's also referred to as the working capital ratio. All of these things refer to the same thing. My chair's a bit squeaky, just FYI. So if we're looking at it, what we're saying, okay, so the current ratio, which is the liquidity ratio, is equal to current assets over current liabilities. So the current ratio, I'm taking my current assets, so this level here, which is all the stuff that I could sell, and I put it over my current liabilities, which is all the stuff that I owe. So another way of thinking about this is that the current assets, okay, these are the things that I own, and they can be sold to turn into cash. Current liabilities are all the things that I owe and that they will require cash. So we're really saying here is how liquid are we, right? How financially stable are we as a business? And the reason why we talk about being financially stable, is because we're looking at this ratio is all about what's our ability to pay back our current liabilities with the current assets. And here, the higher the ratio, the more easily a business can pay back its debts. But we have seen above here the problem of having too many assets. So we want to try and avoid that situation. So that's the theory. Let's get into some sort of application of this knowledge. So let's have a look at this example here. So let's say that a business has current assets of 1,000 and current liabilities of 500. So if I get my pen here, I'm like, oh, okay, so that's current assets, that's current liabilities. So the current ratio, and I would write it each time until you are super familiar with it. So I'd say the current ratio equals the current assets over the current liabilities. In this case would be 1,000 on 500, which equals 2. So what does this mean? So what this means is that for every $1 owed, for every $1 of current liabilities, the business has $2 in assets to cover it. The business has $2 in current assets to cover it. That's a really good situation. So what it means is that if a debt comes along, there are a substantial set of assets to sell, to turn into cash, to be able to pay those obligations. If I think about it, if the ratio is less than 1-to-1 in terms of current assets to current liabilities, that's a problem. So for example, in this situation, if this was reversed, right, and so I say, okay, the current ratio equals current assets over current liabilities. If this was reversed and that was 500 over 1,000, this would now equal 0.5. That's a tricky situation because what we're saying is that for every dollar of liabilities, right, every dollar that is owed, there is only 50 cents worth of assets. So that here, very much a situation where liabilities are larger than assets. So if it's less than 1-to-1, watch out. So the situation we looked at the top is 2-to-1. That's a pretty good situation. I like this explanation here. If it is super large, we get into that problem that we talked about before where the assets are wasted. We've got too many assets that are not going to be used or very productive. So it's a wasteful situation. All right, let's do a practice question. Okay, so we've got a question here and it says calculate liquidity for this business in both years. So I'm seeing calculate, I'm seeing liquidity. So I'll go over here and I'll say, oh yeah, so the current ratio equals current assets over current liabilities. So then I can look here and I've got, okay, so I've got current assets on one side, current liabilities on the other. So I'll just say, let's do the current assets in blue and we'll do the current liabilities in green. So what we'll do is we'll just add this up and we'll say, okay, so here I've got $860 worth of current liabilities in 2012, and then this becomes 1300 there, 660 here, and 1340 over there. So that over here, these ones should be in green. So then what I will do is I'll say, okay, so for, let's say we'll start with 2012, the current ratio equals current assets over current liabilities. So what that's going to do is 2012, okay, so that's going to equal current assets being 860 divided by 660, right? Getting the colors right. So that's above 1, so that's okay. So for every dollar of liabilities, we have $1.3 of assets. So we are here, we are above that 1-to-1 ratio. It would be nice to get to 2-to-1, but that's where we are, and that's okay enough for this example. If we look at 2013, again, you might think it's overkill, but I'm just trying to get us to remember this stuff. So then we've got a situation of 1300, and that this is a problem because it is below that 1-to-1 ratio. So for every dollar of liabilities, we've only got 97 cents in assets, and that could be a problem. So let's look at a couple more questions here. So this question says, for each of the following businesses, calculate the current ratio and compare the liquidity of each business, justifying your answer obvi. Okay, so we know that the current ratio equals current assets over current liabilities, and that here, so we've got 300 over 195. So what I've just done is I've just cancelled out these three zeros because they've both got it. And so if I look at this situation here, I've got 1.5. Let me just double check that. That seems too convenient for me. So it's roughly 1.5. So let's just say approximately 1.5. Okay, so still above 1, so that's cool. And then here, if I do this again, cross off the zeros. Okay, so then current ratio, current asset over current liabilities. So here I've got 450 over 150, and that equals 3. And that's really a good ratio there. So this question here is from the 2012 Business Studies HSC, and that it's got here a balance sheet. And so I can see in terms of the stuff I've got here, current assets are there, got non-current assets, and then I've got current liabilities here. So what I might do is, in this question is I think, okay, current assets, that's my total there, current liabilities, that's my total there. So here you could see question part A, calculate the current ratio, and it gives you the ratio, how nice of them, and then show all working. So you can also see that here there's 2 marks, not just 1. So I would say, okay, the current ratio equals current assets over current liabilities. This is going to then equal 35,000. And I would use the full numbers here because they want to see the working over 14,000, which will give us a current ratio of 2.5. So no interpretation here, but just for our purposes, what we can say is that for every $1 of liabilities, this business has $2.5 in assets. Right? It's a really great situation. Okay, so that was a look at the liquidity ratio. There'll be another couple of videos in terms of the other ratios for the New South Wales Business Studies syllabus. If you've got any questions or issues or cable management strategies, then just let me know. As always, thank you very much for watching.